was listening to the commentary, the news commentary that Richard Gregory read, and it referred to a press conference that Trump had together with his staff this morning. And what was interesting about it is I actually saw this conference. And whereas the media may have reported that that Trump said that this emergency would last at least to August. In fact, that's not what happened. And whereas the media said Trump said there would be a recession, that's not what happened. What happened was that Dr. Anthony Fauci, who is the director of the Institute of Infectious Disease, National Institute of Infectious Diseases in the US, who is now the president's Health Czar, said the longest this could possibly last was July. Okay, and Trump was asked, would there be a recession? He said maybe. Okay, so I think that parameter of the longest it can last to July is really important as a strategic parameter. Now, the last time I spoke to you was Friday, and on Friday, the Fed had provided $1.4 trillion US dollars to the market to add to liquidity. And that is, as I said on Friday, equal to the entire size of the Australian economy. And that is to provide additional liquidity in the repo market to make sure there's enough money in the US banking system. Since then, the Fed has aggressively cut interest rates down to an historic low level of between 0 and 25 basis points. Now, what should happen is the effective Fed funds rate should fall to about 8 basis points. So that will be the level of the money. That you'll see US Treasury bills around about that level. And in addition to that, they have returned to aggressive quantitative easing, saying that they'll buy 500 billion of, at least as the first step, 500 billion of US Treasury bonds and 200 billion of mortgage-backed securities. So what you've got is an enormous amount of stimulus that the Fed has put into the market in a very few days. In addition to that, we know that the RBA is aggressively operating in the Australian repo market to support the Australian banks. And they say that they will announce further actions on Thursday. Now, I imagine that that will be a cut to 25 basis points, and it may also begin quantitative easing in Australia. We will wait to find out. But what I was asked today to talk about, I was asked to talk about the S&P 500. And on the numbers that I worked out this morning, just before working in here when I ran my models again, fair value in the S&P 500 is 2,845 points. Very interestingly, bottom-up operating earnings per share is reported to S&P 500, which is the number we use, has declined very little in the period of this emergency. Now, we'll see what happens in the future. But for that decline in prices that we have now to 2,396 points this morning, to be rational, that means that 12-month rolling operating earnings per share need to fall by 25.75%. Now, that assumes, therefore, that there is no profits of any time this year. It also assumes that the emergency will go on longer than July, which is what Dr. Anthony Fauci has told us. It's really interesting that brings the S&P 500 down to a level today of 459 points, 460 points really, below fair value. I look back at the history that we have in the current model, which is 30 years of history, because the data series that we use began at the end of the 80s. A lot of data systems were rebuilt at the end of the 80s to look at operating earnings per share as the best measure, because it was found in the 1987 stock market crash, earnings numbers weren't good enough at calculating what fair value is. So in that entire series, it's really interesting that the most undervalued that the US equities market has been is not in the financial crisis. It was in fact in September 2011 when the market was 594 points below fair value, because it had anticipated that what was happening in Europe during the foreign debt crisis in Europe would generate a worldwide financial crisis, which never happened. So what you've got is a level of undervaluation in which historically is related to fear, not fundamentals. So what do I think is going to happen here? I think the Fed has thrown an enormous amount of liquidity at the market. Volatility is able to sustain itself in the absence of liquidity. This enormous amount of liquidity, both in the repo market and by cutting rates and by recommencing quantitative easing, will burn away the volatility within a period of no more than 3 months. By the time we get to that period, what we're going to have is a much better horizon of when this emergency is going to end, and I think it will end by the middle of the year. And by that time, a lot of this fear and apprehension about buying stock will have disappeared into history.